Good evening and welcome to our market analysis. Friday's U.S. stock market closed with a clear structural divergence, as tech stocks outperformed while traditional blue chips and crypto-related assets came under significant pressure. The Nasdaq 100, tracked by the QQQ ETF, rose 1.46% to close at $740.62. The S&P 500, tracked by the SPY ETF, edged up just 0.15% to $746.74. The standout performer was Nvidia, the AI chip giant, which surged 2.13%, leading the entire tech sector. Meanwhile, crypto-related assets suffered heavy losses. The iShares Bitcoin Trust ETF fell 2.39%, and MicroStrategy plunged 5.14%. This clearly shows capital is fleeing higher-risk alternative assets and pouring into the AI computing hardware theme. China's A-share market on Friday showed a similar pattern of divergence. The Shanghai Composite Index fell 0.43%, while the Shenzhen Component Index gained 0.94%. The Chi-Next board, which tracks growth stocks, jumped 2.05%. This further confirms that market funds currently prefer tech and growth stocks over value-oriented blue chips. However, a wave of negative news over the weekend could disrupt this continuity. These include new U.S.-China technology export controls, the European Union's additional tariffs on Chinese electric vehicles, and the breakdown in Apple and Tencent's AI cooperation talks. Looking at the global market path, during the Asian session, Friday's A-share data already validated the divergence between tech and blue chips. For the European session, specific index data is unavailable, but the EU tariff announcement made on Friday may have been partially reflected in European stock trading. During the US session, tech and AI chip stocks closed strongly, but crypto-related stocks fell sharply, with no clear turning point in the final hour. After the weekend news broke, Asian markets on Monday will face the combined effect of U.S. tech strength and weekend headwinds. The critical turning point could appear within the first 30 minutes of trading. Reviewing our morning report from yesterday, we correctly predicted that the Chi-Next board would maintain its strength and advised focusing on the domestic substitution theme. Friday's 2.05% gain in Chi-Next validated this call. However, the biggest surprise was the concentrated release of multiple geopolitical and trade risks over the weekend, which our report failed to anticipate. Additionally, the positive impact of extreme heat on energy demand only became a weekend focus, meaning the energy sector had not yet priced this in by Friday. Notably, crypto-related stocks have weakened for 2 consecutive days with no positive catalysts over the weekend. This may have formed a medium-term downtrend, with a probability of around 65%. On the stock radar, several opportunities and risks deserve attention. Wolfspeed, a silicon carbide material supplier, benefits from the AI data center power demand logic and may show a range-bound to slightly stronger trend over the next 1 to 3 trading days, with a probability of about 62%. The Japanese InP substrate company 5802.T is relatively resilient, with its catch-up progress at 49.4% and low geopolitical risk. It can be held over the next 1 to 5 trading days. However, AXTI, based in Beijing with high geopolitical risk and zero catch-up progress, warrants an exit recommendation. Due to the absence of key data including the U.S. dollar index, the dollar-yuan exchange rate, and the 10-year Treasury yield, our three-dimensional linkage analysis is severely limited. Based on available data, we can infer that capital is flowing from crypto-risk assets into tech stocks, rather than following traditional stock-bond currency linkages. The Chi-Next and Shenzhen indices strengthening while Shanghai weakened reflects domestic capital's preference for tech innovation. On the capital flow front, AI computing hardware remains the strongest market theme with a 70% probability. Nvidia already attracted capital inflows on Friday. While the weekend export control news is negative, it targets advanced chip exports rather than AI demand itself. The long-term logic for computing power remains intact, and this theme's leading position is unchanged. The second strongest theme is natural gas and power, driven by extreme heat boosting energy demand, with a 55% probability. The weakest theme is crypto-related assets, with a 75% probability. They accelerated their decline on Friday and lack any positive catalysts over the weekend. For tomorrow's trading strategy, we offer several verifiable predictions. Hong Kong's Hang Seng Tech Index may fall 1–2% in Monday's early session, driven by the Apple-Tencent AI cooperation breakdown. Chinese rare earth and gallium-germanium control beneficiary stocks may rise 3–5%, catalyzed by China's July 1 export control announcement. The U.S. dollar index may strengthen slightly by 0.2 to 0.5% as U.S.-China trade tensions boost safe haven demand. Nvidia may experience a choppy pullback of 1 to 3% as profit-taking follows the control news. Overall, today's model self-assessment scores 7 out of 10. We correctly predicted Chinex's continued strength but failed to anticipate the concentrated weekend geopolitical risk. Our strategy model needs adjustment, raising the forward-looking weight for geopolitical and trade policy events from 5% to 15%. We also need to add weekend event risk as a mandatory check item after Friday's close. For final trading recommendations, our strategy confidence level stands at 65%. We suggest maintaining controlled long positions but only after confirming the market open. If Asian tech stocks open lower but do not break key support levels, investors can gradually build positions in domestic substitution and energy defense plays. However, if major indices gap down more than 3% or the dollar index jumps more than 0.8% in a single day, we should abandon positioning. Our probability assessment for today stands at 30% for an up move, 35% for a sideways move, and 35% for a down move. Investors should remain vigilant and adapt flexibly to the impact of weekend news.